Nvidia just reported earnings and the stock fell around 1% in after-hours trading. At the latest price, the company now has a market cap of $3.57 trillion. Revenue over the last 12 months comes to $121 billion, with $63 billion of net income and $56 billion of free cash flow. So Nvidia stock is now valued at 29 times revenue, 57 times earnings, and 63 times free cash flow. There's no doubt that this was a good earnings report from Nvidia. Q3 revenue grew 17% from the previous quarter to $35 billion. That was above expectations and an acceleration in sequential growth. Net income surged to $19.3 billion, a margin of 55%. On the company conference call, Nvidia management said that demand for its latest Blackwell product was staggering. Large companies continue to build out their AI factories. They're developing new AI products and services and bringing in significant increases in revenue. Recent results out of Google Cloud, Amazon, AWS, and Meta back this up. If there was an issue with today's report, it was the company's outlook for next quarter. Management expects sequential growth of about 7%, which is lower than previous quarters, and gross margins are set to drop to the low 70s as the company rolls out Blackwell. This decrease comes from a higher cost of production and could be a sign that players like TSMC are starting to take a bigger cut of profits. There's also been concern lately that AI companies might be facing diminishing returns. An article in Bloomberg reported that companies like OpenAI, Google, and Anthropic are struggling to make significant improvements to their latest models. That could slow down the purchase of new systems. And a report last weekend said that Blackwell was having issues with overheating. CEO Jensen Huang, however, played down both of these concerns. He said that companies are still finding new ways to scale the technology, and their biggest problem right now is keeping up with the exceptional demand from customers. So there's really no question as to the health of Nvidia's business. The more important question is whether the stock can still deliver mouth-watering returns. Let's assume that Nvidia achieves 50% revenue growth next year and then 25% revenue growth for the following 9 years, with free cash flow margins of 45%. In that scenario, the company would produce around $2.7 trillion of free cash flow over the next 10 years. Include some cash flows after year 10, discount those cash flows and account for stock-based compensation, and the stock appears to be overvalued by about 14%. That's using a discounted cash flow model that assumes a 10% discount rate and a 3% terminal rate, and it feels like a pretty aggressive forecast. So Nvidia may be the best company in the world right now, but the stock price leaves very little reward for investors. But these are my personal opinions, not financial advice, and I hold no position in Nvidia stock. For more investing videos, make sure to visit my website at 3minutebreakdowns.com. Thank you for watching.